Gautam Trivedi joins us. Let's take a conversation forward with him, Managing Director with Nepean Capital. Gautam, good morning. Thank you for joining us. Makes
Hi,
sense for
Anuj.
us.
Morning.
It's absolute madness in the market, isn't it?
Yeah. No, it is. And I think the fact that for the 13th month in a row, a successive month, FIs have been selling. We've seen almost now $22 billion of net selling by foreign institutional investors. So that clearly tells you where they think value is. Clearly, it's not in India at this point. They seem to be putting in significantly more money into China and Hong Kong. Let's not forget, Hong Kong is the fourth largest country by market cap in the world, $5.7 trillion. So that in itself is a big market. Yes, I do agree. Part of it is contributed by the Chinese 8 shares listed on the Hong Kong Stock Exchange. But having said that, it's big enough to attract enough money. And I think some of that is indeed happening. Those flows are indeed happening at the expense of India, i.e. booking profits here and plowing it back into the reopening trade in Hong Kong and China.
Gautam, tell me whether or not this entire Adani episode, I mean, of course, it's in the international media glare as well. But does it tarnish the India image in any which way, or further tarnish the India image when you already have FIIs exodus play out for 13 months, like you rightly said?
I think the FI exodus was happening even before Adani, long before Adani, and more to do with valuations than anything fundamentally wrong with the country. I think the country is clearly on a very strong growth path. More importantly, I think the budget has reinforced that, and frankly, I was personally very, very surprised and happy with the budget because there was this overhang of capital gains tax that could have potentially had a bigger impact on the market than even the Adani episode. But thankfully, that didn't happen. But having said that, I think, yes, there would be some degree of an impact. The second or third richest man in the world loses as much as $108 billion. That's a significant amount of money to lose in 5 to 6 trading days. So that's something which I, honestly would say that would be what international investors would be talking about at this point. But I think this too shall pass. India is resilient. We've got some great companies in India. And some of these Adani stocks potentially could be attractive at lower levels. So I think I would put India past this episode.
Lenders, especially PSU banks, in connection with that, if there is something wrong which could happen to Adani Group, the fallout of that could have impact the books of the lender. Is that fear slightly overdone?
The banks that have actually come out and publicly acknowledged their exposure to the Adani Group are few. So it doesn't seem like there seems to be a big deal, with the exception of maybe an SBI. An LIC, I would call a lender in some sense because their exposure, as they said, is 56,000 crores, which is no small amount. But I think outside of that, the private sector banks have clearly not been impacted, as have, I think, most of the other PSU banks. So given what's available in terms of public knowledge about where the exposures lie, I really don't see that being a big deal. I think the concern should be more for the foreign banks, if at all.
Gautam, hi. Let's understand then what exactly the strategy is at the current juncture. Have there been any recent additions to the portfolio?
Yes, we've added 3 stocks in the past quarter. Sirma SGS, we've added Landmark Cars, which recently IPO'd, and Sapphire Foods. And again, in the case of Sapphire and Sirma, we were very conscious about valuation protection given all this talk about a potential recession in the US, and that, and again, in turn, impacting the rest of the world. So we chose to stick to companies that where we thought were significantly trading at a discount to their other listed peers. For example, Dixon, we thought was very pricey, has had a pretty good correction since. And some of the other names in the QSR space, with respect to Sapphire, being the cheapest within the QSR space. So these are the 3 we've added. Landmark, of course, is India's largest automobile dealer, ex-Maruti. I know the promoter personally, and he's done a fantastic job over the last 25 years building out a great business, 8 states, 113 locations, and 33 cities, and continues to want to expand. So very hardworking guy, and I wish we could find more promoters and companies like that.
Yeah. But Gautam, tell me, that's the part of the market which is throwing up value right now. What's the part of the market you're completely avoiding or have in the last, say, 6 odd months?
So we've stayed away from PSU banks and in general PSUs, though of course we've not looked at the defense space, which in some sense has been a miss. Those stocks have done very well, and so we've avoided, I think, mostly PSUs. We've avoided, I guess, to some extent, the insurance plays where we could have done more, but chose not to. But I think otherwise we are very stock specific, and we're not really agnostic to a specific industry because our investment philosophy is very trigger based. We need to see a trigger in a stock that we think, or a significant valuation discount that we think will help that stock re-rate at some point. So we're long-term investors, long-only strategy. Average holding period is at least 2 to 3 years for these stocks, and we continue to believe in these names that we've invested in so far.
Why PSUs and why in specific PSU banks? I mean, it's been the best performing index of the past year.
I agree with you. The only thing is, with respect to the PSU banks, the FM did make a mention in a budget 2 years ago that two of the PSU banks will be privatized without naming which two. And as a result, the rally took all of the PSU banks up without anybody being able to guess which two. But then again, that hasn't happened. I think the overall banking sector has been cleaned up, and frankly, the PSUs have benefited from that, and good luck to them. But we prefer to put money into private sector banks where, for the most part, there is better transparency and better controls over fraud. So that's the reason we prefer the private sector banks.
The companies which you bought into, let's say Sapphire Foods or Landmark, they're urban plays. They're not the cheapest stocks.
Yeah.
And at a time when everybody's excited about capex, industrial, cyclicals, why buy consumer names, which are great businesses but expensive?
Yep.
And from a market standpoint, that end of the market, which is urban consumption, is not in a bull run.
Well, let me put it this way. In the case of Landmark, let's take that as an example. Landmark is the only really listed player in the auto dealership business in India. So that's only one of its kind. And I think the market is still coming to grips on how exactly to value this company. I don't blame them because there is no listed other peer in a true sense. There are listed players in China, in the US, but those markets are ex-growth. India closed 2022 with 3.8 million passenger cars sold. Forget about the 27 million that China sells every year. Even if we get to 8 million in the next 3 to 4 years, that itself will be a massive quantum leap for the market, and I think Landmark will be a beneficiary of that. The second point to note is based on our internal estimates, Landmark's at about 12.5 to 13 times FY24 PE. So it's really not that expensive.
I look at autos. In last 5 years, autos in general have done nothing. I mean, I used to always think that Tata Motor is suffering because of JLR. But when I look at the stock of Maruti also, 5 years flat return. With the exception of Mahindra,
Yeah.
none of the auto stocks have made money. Why is that auto in last 5 years, when the promise of auto is so strong, have not really made money?
Here's the thing. I think the market has moved away from the entry-level cars. It's getting to the premium end. It's getting into the luxury end. And I think even the absolute numbers, to compare like to like is actually deceiving. Look at value to value, and that's really where I think the opportunity lies, and that's where the growth is. So if you look at even, I think the CEO of Tata Motors recently said that about 12 years ago, the average selling price of a car was about 5.5 to 6 lakh rupees. It's 15 lakh rupees today. So aside from inflation, I think the absolute amount of people are spending on a car has significantly increased, and that's the I think way forward if you look at it. So I think looking at absolute numbers of the number of cars sold is a little deceiving. You have to look at the value that's actually increasing year on year.
Why do you like Dixon? I mean, they came out with poor set of numbers. This was like the ultimate secular trend that, okay, in India, mobile phone, camera manufacturing, fridge manufacturing will only increase. But when you see so much of volatility in the numbers, it makes you wonder that is it a linear business or is it a cyclical business?
Actually, Anuj, what I said was that we don't own Dixon. We actually bought Sirma SGS because it was trading at a 45% discount at the time to Dixon. So we avoided Dixon and put money into Sirma. And I think Dixon's a great company too, but I think valuations will really stretch at the time.
Okay. All right, Gautam. Really appreciate your time. Thank you for joining us on ET Now.
Thank you.